Have you ever entered a trade after a breakout, only to watch the price reverse against you? In this video, I'll break down this exact setup, explain why it looked bullish, and why it completely failed, so that next time you don't fall for this trap. Stay with me till the end. This lesson could save you hundreds of dollars in losses. Let's begin by looking at the horizontal blue resistance line. You'll notice that price previously rallied into this level and then paused, creating a consolidation zone. We've highlighted this area with a yellow box. This pause at resistance is important because it shows the market is testing a key supply level. But buyers pushed the price up but couldn't go higher. Sellers stepped in, creating wicks and small-bodied candles, a classic sign of hesitation. This is where smart traders wait instead of rushing in. Now notice the market comes back to this level a second time, shown in another yellow box. Again, we see price stalling at the same resistance, confirming that this is a strong level where sellers are active. This second pause builds even more trader interest, especially breakout traders who think, if price breaks this level, it'll fly up. But is that what really happens? Let's see. Finally, we see a candle that closes above resistance, giving the illusion of a breakout. Many traders jump in long at this point. It makes sense on the surface. The breakout is above both the resistance line and the 25 EMA shown in orange. Also, the price action is above the moving average, which typically signals bullish momentum. But here's the trap. The breakout lacks real strength. The movement after the break is weak, as shown in the green circled area. The candles are small. There's no real momentum or follow-through. This is a key warning sign. Here's the biggest issue. After the breakout, the market doesn't move strongly upward. In a real breakout, we expect large bullish candles, quick movement, and volume confirmation. But what we see here is hesitation. The candles have long upper wicks, suggesting selling pressure. This means that although the breakout candle closed above resistance, sellers immediately returned to push the price down. That's a big red flag for experienced traders. Then comes the big red candle. This candle doesn't just reject the breakout, it closes back below the resistance and under the EMA. That's strong confirmation that the breakout has failed. It shows us that sellers were in control all along and that the bullish move was a trap, a classic bull trap. This kind of rejection is often followed by strong downside movement, as we see next on the chart. So why did this setup fail? There are three main reasons. The breakout had no momentum. Small candles after a break mean traders are not fully committed. Long wicks showed heavy selling pressure even above resistance. No retest confirmation. Price didn't pull back to confirm the breakout level before continuing. Together, these are signs of a fake breakout, and anyone who bought in would be stopped out quickly. This is why waiting for confirmation and volume is crucial. Here's how to protect yourself from these traps. Wait for follow-through after breakout. Look for strong, clean, bullish candles. Use volume indicators. Volume should increase on a real breakout. Watch the retest. Real breakouts often come back to retest the previous resistance as support. Don't rush. The best setups wait for confirmation, not just the first break. Learning this can save your account from unnecessary losses. So instead of buying at the breakout, a smarter entry would be to wait for the break and retest and only enter after confirmation. If the market doesn't give that, you skip the trade. No confirmation, no entry. This is the difference between professional traders and those chasing every breakout. Remember, trading is about probability, not prediction. This chart is a perfect example of wrong entries and breakout failures. Even though price was above the moving average, even though resistance broke, the price action didn't support the move and the rejection confirmed the trap. Now that you've seen what a failed breakout looks like, let's compare that with a successful breakout and retest trade, where the price behaves exactly how a professional trader would expect. This next chart is a perfect example. Let me walk you through it, step by step. This level was tested not once, not twice, but 4 times by the market. Each time the price tried to break through but was rejected hard. These 4 reactions prove that this is a very strong resistance level. Sellers are clearly defending this zone, and it's being respected. This is the type of level we mark as high probability. We expect a big move if it eventually breaks. Now watch what happens next. The price finally breaks above the resistance with strong bullish candles, but this is different from the first chart where the breakout was weak. Here the breakout is clear, clean and powerful. Large-bodied green candles push price above the zone. This is our first confirmation. The resistance is breached, and now that resistance becomes support. This is what traders call a market structure shift, and it's one of the most reliable signs of a trend continuation. But here's the smart part. You don't enter the trade on the breakout. Instead, you wait for the price to come back down and test the newly formed support level. This is exactly what happens here. The market pulls back, calmly and naturally, and touches the blue line again. 50.26. This is the retest. At this moment, you're looking for price to respect that level and bounce upward. This is where many traders either get in too early or give up, but patience pays off. Now look closely. After the retest, we see a bullish reaction. Green candles start forming again, showing us that buyers are stepping back in. This is the perfect moment to enter a long trade, exactly where the chart marks it. This kind of setup has everything in its favor. The district, a clear retest, good risk to reward setup. From here, the price launches upward, giving you a clean entry with minimal drawdown. Let's recap what we've just seen using both charts. In the first chart, we saw a fake breakout. No momentum, no retest, and a strong rejection. In the second chart, we saw a proper break and retest setup, a trader's dream pattern. Here's what to always remember. Don't chase breakouts blindly. Wait for a retest to confirm support or resistance flip. Look for candle confirmation and patience is more powerful than prediction. If you apply this break and retest strategy, you'll avoid countless losses and trade with the confidence of a pro. If you got value from this video, don't forget to like, comment and subscribe to Financial Freedom FX. Type break and retest in the comments if you're ready to trade smarter.